How blockchain is disrupting traditional wealth management. The emergence of blockchain technology has been nothing short of revolutionary, and its influence is spreading across multiple sectors, with wealth management being one of the most affected. Traditionally, wealth management has been a relatively conservative industry, relying on trusted intermediaries such as banks, asset managers, and financial advisors to handle the financial assets of clients. However, blockchain, a decentralized digital ledger technology that records transactions in a secure, transparent, and immutable manner, is reshaping this landscape. Its application in wealth management is breaking down traditional barriers, enabling greater efficiency, reducing costs, and providing more personalized, secure, and transparent services to clients. At its core, blockchain is a decentralized and distributed ledger that securely records transactions across multiple computers, ensuring that data is immutable and transparent. The technology offers a level of security and transparency that was previously unattainable in traditional financial systems, where intermediaries like banks and brokers played a crucial role in facilitating transactions. Blockchain allows for peer-to-peer transactions without the need for trusted intermediaries, making it a natural fit for wealth management, where security, trust, and transparency are paramount. The first and most significant way blockchain is disrupting wealth management is by reducing reliance on intermediaries. Traditional wealth management services often require the involvement of banks, custodians, brokers, and other financial institutions to facilitate transactions and manage assets. Each of these intermediaries adds costs, time delays, and potential risks, especially in cross-border transactions. Blockchain technology eliminates these intermediaries, allowing wealth managers to directly transact with clients and other parties in a more efficient and cost-effective manner. This disintermediation of traditional financial institutions can lead to lower fees, faster transactions, and reduced complexity, all of which benefit the end client. In the context of asset management, blockchain has the potential to democratize access to investment opportunities that were previously available only to high-net-worth individuals or institutional investors. Through blockchain, assets such as real estate, fine art, and private equity can be tokenized, represented as digital tokens on the blockchain. Tokenization enables fractional ownership, allowing individuals to invest in assets with smaller capital amounts, thus broadening access to diverse investment opportunities. This democratization of investment is a major step toward leveling the playing field and providing more inclusive financial services to a wider range of people, regardless of their wealth or geographical location. Moreover, blockchain's transparency is transforming how wealth managers provide services to their clients. In traditional wealth management, clients often rely on their advisors to provide accurate information and reports about their investments. These reports, however, can be opaque and prone to errors or biases. Blockchain, on the other hand, provides a transparent, immutable record of all transactions, enabling clients to track their investments in real time. This transparency builds trust between clients and wealth managers, as clients can independently verify the status of their investments without relying solely on the information provided by intermediaries. Blockchain's immutability is another factor that is changing the wealth management landscape. The decentralized nature of blockchain ensures that once a transaction is recorded, it cannot be altered or deleted. This feature is crucial in ensuring the integrity of financial records. In the wealth management sector, where accurate record-keeping is essential for regulatory compliance and client trust, blockchain offers a level of security that traditional systems struggle to match. With blockchain, wealth managers can ensure that client records are tamper-proof, and any changes to a portfolio or financial transaction are permanently recorded, reducing the risk of fraud or manipulation. In addition to improving transparency and security, blockchain also offers significant benefits in terms of efficiency. The process of transferring assets or executing trades in traditional wealth management can involve several layers of intermediaries, each requiring time and resources to process transactions. Blockchain streamlines this process by enabling peer-to-peer transactions that occur almost instantly and at a fraction of the cost. The use of smart contracts, self-executing contracts with the terms of the agreement directly written into code, further enhances efficiency by automating many of the tasks traditionally handled by financial institutions, such as verifying transaction terms, executing trades, and distributing dividends. For instance, in a typical scenario, A client may need to place an order to buy or sell an asset through a broker, who then communicates with a custodian or clearinghouse to settle the trade. This process can take days, especially when international transactions or different time zones are involved. By using blockchain, these transactions can occur almost instantaneously, without the need for intermediaries to validate each step. Additionally, smart contracts can be programmed to execute the trade when predefined conditions are met, removing the need for manual intervention and reducing the likelihood of human error. Regulatory compliance is another critical area where blockchain technology is making a significant impact. Wealth management firms are subject to a wide range of regulations, such as anti-money laundering, AML, and Know Your Customer, KYC, requirements, which are designed to prevent fraud and ensure the integrity of financial transactions. Compliance with these regulations often requires extensive documentation and verification processes, which can be time-consuming and costly. Blockchain can streamline compliance by providing an immutable and transparent record of all transactions, making it easier for wealth managers to demonstrate that they are adhering to regulatory requirements. Furthermore, blockchain can help automate KYC and AML processes through the use of digital identities and smart contracts, further reducing administrative burdens. Blockchain also introduces new opportunities for private wealth management by offering innovative products and services that can be tailored to individual client needs. For example, through decentralized finance (DeFi) platforms, clients can gain access to lending, borrowing, and yield-generating opportunities without relying on traditional financial institutions. DeFi platforms use blockchain to offer financial services such as lending, borrowing, trading, and insurance directly to users, bypassing intermediaries like banks. Wealth managers can leverage these platforms to create customized financial solutions for their clients, whether it's through decentralized lending or earning yield on crypto assets, all while maintaining greater control and privacy over their assets. The rise of cryptocurrencies and digital assets has also significantly impacted the wealth management industry. Many traditional wealth managers have been slow to adopt cryptocurrencies due to concerns about volatility, regulation, and security. However, blockchain's role in facilitating the creation and management of digital assets has led to the development of new investment strategies that incorporate cryptocurrencies, such as Bitcoin, Ethereum, and other altcoins. These digital assets offer a new avenue for portfolio diversification and the potential for high returns. Wealth managers who embrace blockchain technology and cryptocurrencies can help their clients access these emerging asset classes, which could potentially offer substantial growth opportunities in the long term. Blockchain's integration with other technologies, such as artificial intelligence, AI, and machine learning, further enhances its potential to disrupt wealth management. AI can be used to analyze vast amounts of data on the blockchain, identifying patterns, trends, and investment opportunities that would be difficult for human advisors to detect. Machine learning algorithms can help wealth managers create personalized investment strategies by analyzing client preferences, risk tolerance, and financial goals, all while leveraging the data stored on the blockchain to provide real-time insights. Blockchain technology is fundamentally altering the wealth management industry by providing greater efficiency, transparency, security, and inclusivity. Its decentralized nature and ability to eliminate intermediaries are making traditional wealth management services more accessible and cost-effective, while also introducing new investment opportunities and innovative financial products. Blockchain's ability to create immutable, transparent records is also enhancing trust between wealth managers and clients, ensuring that investment transactions are secure and verifiable. As blockchain continues to evolve and integrate with other emerging technologies, its impact on wealth management is likely to become even more pronounced, further disrupting traditional financial systems and shaping the future of wealth management in a more inclusive and decentralized manner. The impact of smart contracts on financial transactions in the evolving world of digital technology. One of the most groundbreaking innovations to emerge in recent years is the concept of smart contracts. These self-executing contracts with the terms of the agreement directly written into lines of code have the potential to revolutionize the way financial transactions are executed. Smart contracts, built primarily on blockchain technology, offer a decentralized and automated way to handle financial agreements without the need for intermediaries. This video delves into the profound impact smart contracts are having on financial transactions, from reducing costs and increasing efficiency to enhancing security and improving transparency in ways that were once unimaginable. To understand the impact of smart contracts, it is essential to first define what they are and how they work. A smart contract is a computer program that automatically enforces and executes the terms of a contract once predefined conditions are met. These conditions are written directly into the code, and the contract is deployed on a blockchain network. When both parties to the contract fulfill their obligations, the smart contract automatically executes the agreed-upon action, such as the transfer of assets, payment, or delivery of services. Since smart contracts are stored on blockchain networks, they benefit from the security, immutability, and transparency that come with decentralized ledger systems. The result is an agreement that requires little to no intervention from third-party entities such as lawyers, banks, or notaries. One of the most significant benefits of smart contracts in financial transactions is the reduction of intermediaries. Traditionally, financial transactions often require intermediaries like banks, brokers, payment processors, and legal professionals to ensure that all terms are adhered to and that the transfer of funds or assets is completed securely. Each of these intermediaries charges fees, which increase the overall cost of the transaction and slow down the process. Smart contracts eliminate the need for these middlemen by directly connecting the two parties in a secure and automated environment. This disintermediation not only reduces transaction costs but also speeds up the process, making transactions faster and more efficient. For instance, in the case of international money transfers, smart contracts can eliminate the delays associated with bank processing times, currency conversions, and intermediary banking institutions, enabling cross-border payments to be completed in a matter of minutes rather than days. Furthermore, smart contracts provide a new level of security in financial transactions. The decentralized nature of blockchain technology ensures that the contract is stored across multiple nodes in the network, making it highly resistant to tampering or hacking. Once a smart contract is deployed, it cannot be altered or changed by any party, ensuring that the terms of the agreement are enforced as written. This immutability reduces the risk of fraud or manipulation, which is a critical concern in traditional financial systems. In addition, smart contracts use advanced cryptographic techniques to protect sensitive data and transactions, further enhancing security and privacy. Smart contracts also enhance transparency in financial transactions. In traditional financial systems, many aspects of a transaction, such as fees, processing times, and the terms of agreements, are often opaque and not easily accessible to all parties involved. With smart contracts, the terms of the agreement are written into the code, and once deployed on the blockchain, they are publicly visible to all participants in the network. This transparency ensures that both parties have access to the same information, reducing the chances of misunderstandings or disputes. It also promotes accountability, as any attempt to alter the terms of the contract would be easily detectable on the blockchain. One area where smart contracts are making a significant impact is in the realm of financial services and lending. Traditionally, lending and borrowing agreements involve complex paperwork, credit checks, legal procedures, and often lengthy approval processes. Smart contracts streamline this process by automating the terms and conditions of the loan. For instance, in decentralized finance, DeFi, platforms, borrowers and lenders can enter into smart contract agreements that specify the loan amount, interest rate, and repayment schedule. Once the borrower fulfills the terms of the loan, the smart contract automatically releases the funds. If the borrower fails to repay on time, the contract can automatically trigger penalties, such as the seizure of collateral. This automation reduces the need for manual intervention, speeds up the lending process, and increases the efficiency of the entire system. Moreover, smart contracts are reshaping the world of securities and asset management. In traditional financial markets, securities, such as stocks, bonds, and commodities, are bought and sold through intermediaries like stock exchanges, brokers, and custodians. This process can be time-consuming and expensive due to the involvement of multiple parties and regulatory requirements. By using smart contracts, securities can be tokenized, meaning they are represented as digital tokens on a blockchain. These tokenized securities can be bought, sold, and transferred directly between parties without the need for intermediaries. Smart contracts automatically execute these transactions based on the predefined terms, such as the transfer of ownership or payment. The result is a faster, more efficient, and less costly way to trade and manage assets. One of the key advantages of smart contracts in securities trading is the ability to create programmable assets. Programmable assets are digital representations of traditional securities that can be programmed with specific conditions and actions. For example, a smart contract governing a tokenized stock could automatically trigger a dividend payment when certain conditions are met, such as when the company reaches a specific revenue threshold. Programmable assets have the potential to unlock new financial products and create more customized investment opportunities, making the financial markets more dynamic and accessible. Smart contracts also offer significant advantages in the insurance industry. Traditionally, insurance claims require extensive documentation, verification, and approval from various parties, which can lead to delays and disputes. By implementing smart contracts, insurance companies can automate claims processing, making it faster and more efficient. For example, in the case of flight delay insurance, a smart contract could be programmed to automatically trigger a payout when a flight is delayed by a specified amount of time. The smart contract would access data from external sources, such as flight tracking services, to verify the delay, and then automatically execute the payment to the policyholder. This automation reduces administrative overhead, speeds up claims processing, and minimizes the potential for fraud. In addition to traditional financial services, smart contracts are playing a significant role in the emerging field of decentralized finance, DeFi. DeFi refers to financial services that are built on blockchain networks, which allow for peer-to-peer transactions without the need for intermediaries. Smart contracts are the backbone of DeFi platforms, enabling users to borrow, lend, trade, and earn interest on their digital assets without relying on traditional banks or financial institutions. For example, users can lend their cryptocurrency to others through decentralized lending platforms, with the terms of the loan, including interest rates and collateral requirements, automatically enforced by smart contracts. DeFi is expanding the possibilities for financial inclusion by providing access to financial services to people who are unbanked or underbanked, as these services are accessible through an internet connection and do not require a traditional bank account. Despite the many advantages of smart contracts, they are not without challenges. One of the primary concerns is the issue of code vulnerability. While blockchain technology is generally considered secure, smart contracts are only as secure as the code they are written with. If there are bugs or vulnerabilities in the code, malicious actors could exploit them to manipulate the contract or steal funds. As a result, it is essential for developers to rigorously test and audit smart contracts before they are deployed on the blockchain. Additionally, smart contracts often rely on external data sources, known as oracles, to trigger certain actions. If the oracle providing the data is compromised, it could result in incorrect or fraudulent execution of the contract. Another challenge is the legal recognition of smart contracts. While smart contracts are gaining traction in the tech community, their legal status remains unclear in many jurisdictions. Governments and regulatory bodies are still working to determine how to recognize and enforce smart contracts in the traditional legal system. Until clear legal frameworks are established, there may be uncertainty about how smart contracts will be treated in case of disputes or breaches. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Exploring decentralized finance, DeFi, platforms for wealth building. Decentralized finance, DeFi, has emerged as one of the most transformative innovations in the world of finance, shifting the landscape from centralized banking systems to open, peer-to-peer networks powered by blockchain technology. DeFi offers individuals the opportunity to engage in financial activities such as lending, borrowing, trading, investing, and earning interest without relying on traditional intermediaries like banks, insurance companies, or brokers. Instead, DeFi platforms use smart contracts and decentralized applications, DApps, to automate and facilitate financial transactions, enabling users to have full control over their assets. This video explores how DeFi platforms are opening new avenues for wealth building and democratizing access to financial services, and why they are rapidly gaining attention from individuals, investors, and financial institutions. At the heart of the DeFi revolution is the concept of decentralization. In traditional finance, intermediaries play a central role in ensuring that financial transactions are conducted securely and efficiently. Banks, for example, are responsible for managing deposits, loans, and payments, while stock exchanges and brokers facilitate the buying and selling of securities. These intermediaries typically charge fees for their services and can impose restrictions on who has access to financial products. DeFi, by contrast, operates on blockchain networks, where transactions are recorded on a public ledger accessible to anyone with an internet connection. By removing intermediaries, DeFi platforms offer more transparency, lower fees, and faster transaction times. One of the most exciting aspects of DeFi is its ability to offer inclusive financial products that are accessible to anyone, regardless of their geographical location or financial background. Traditional banking systems often exclude individuals from underserved or unbanked regions, where access to banking services can be limited or expensive. DeFi platforms break down these barriers by enabling anyone with a smartphone or internet connection to participate in financial markets. Users do not need to meet strict credit requirements or navigate complex paperwork to access financial services. As a result, DeFi has the potential to bring financial inclusion to millions of people around the world who have been excluded from the traditional banking system. Lending and borrowing represent one of the most popular and impactful use cases of DeFi platforms. In the traditional banking system, obtaining a loan often requires an individual to go through a lengthy approval process, including a credit check, application fees, and waiting periods. DeFi lending platforms, on the other hand, enable individuals to borrow and lend cryptocurrencies directly with one another without the need for banks or other financial intermediaries. Platforms like Aave, Compound, and MakerDAO allow users to deposit digital assets into liquidity pools, which other users can then borrow. Lenders earn interest on their deposits, while borrowers can access loans quickly by offering collateral in the form of digital assets like Ethereum or stablecoins. The key advantage of DeFi lending is the ability for users to earn interest rates that are often higher than those available in traditional savings accounts or fixed deposits. Interest rates on DeFi platforms are typically determined by supply and demand within the platform's liquidity pools, meaning that borrowers may have to pay higher interest rates during times of high demand, while lenders can benefit from higher returns. In contrast, traditional banks often offer lower interest rates on savings accounts due to the centralized nature of their operations. By participating in DeFi lending platforms, users can optimize their wealth building potential by earning interest in a decentralized and transparent manner. Borrowers, on the other hand, benefit from DeFi lending platforms by accessing loans without the need for a credit score or lengthy application process. The collateralization mechanism, where borrowers must lock up a certain amount of assets to secure a loan, reduces the risk for lenders while allowing borrowers to access funds with fewer restrictions. For example, if someone wishes to borrow USDT, a stablecoin, they can deposit a certain amount of cryptocurrency like Ether or Bitcoin as collateral. As long as the value of the collateral remains above a certain threshold, the loan can be taken out without the need for a traditional credit check. This opens up borrowing opportunities for individuals who may have limited access to traditional credit facilities. Another key feature of DeFi platforms is the ability to trade and exchange cryptocurrencies on decentralized exchanges, DEXs, without the need for intermediaries like centralized exchanges. Popular DEXs such as Uniswap, SushiSwap, and PancakeSwap allow users to swap one cryptocurrency for another directly, using liquidity pools rather than relying on an order book. This is made possible by the use of automated market makers, AMMs, which automatically determine the price of assets based on the supply and demand within the liquidity pool. Because these platforms are decentralized, users retain full control of their assets at all times and can trade without entrusting their funds to a third party. Decentralized exchanges also offer the potential for wealth building through liquidity provision. On platforms like Uniswap, liquidity providers, LPs, can earn fees by depositing pairs of cryptocurrencies into a liquidity pool. These fees are paid by traders who swap assets using the pool, and LPs receive a portion of the trading fees proportional to their share of the liquidity pool. The return on investment for liquidity providers can be quite attractive, especially during times of high trading volume. However, liquidity provision also comes with risks, such as impermanent loss, which occurs when the value of the assets in the pool changes relative to one another. Nevertheless, for many, the potential for passive income through liquidity provision has become a compelling way to grow wealth in the DeFi space. Staking is another mechanism through which DeFi platforms allow users to build wealth. Staking involves locking up cryptocurrency assets in a network to support its operations, such as validating transactions or securing the network. In return for staking their assets, users are rewarded with additional tokens or interest payments. Many DeFi protocols, such as Ethereum 2.0, the upgraded version of the Ethereum network, and Cardano, enable staking for network security and governance purposes. Through staking, users can earn rewards that compound over time, contributing to long-term wealth accumulation. Staking has gained popularity because it provides a way for cryptocurrency holders to earn passive income on their holdings, without having to sell or actively trade their assets. Yield farming, or liquidity mining, is another wealth-building opportunity within DeFi platforms. Yield farming involves using assets to provide liquidity to decentralized protocols in exchange for rewards in the form of governance tokens or additional cryptocurrency. These rewards can then be reinvested to generate further returns. Yield farming has grown exponentially in popularity due to the high returns that can be generated, especially when new projects or tokens are launched. However, yield farming can be complex and comes with risks, including smart contract vulnerabilities, market volatility, and impermanent loss. For those who are willing to take on higher risks, yield farming can be a way to maximize potential gains. One of the major benefits of DeFi platforms is their openness and transparency. Unlike traditional financial systems, where processes are often opaque and decisions are made behind closed doors, DeFi platforms are built on open-source protocols that anyone can access and audit. Transactions are recorded on a public blockchain, meaning that users can verify the activity on the platform in real time. This transparency not only fosters trust within the DeFi community but also ensures that the platform's operations are transparent, secure, and auditable. The openness of DeFi platforms has led to the development of decentralized governance models, where users can vote on decisions related to the platform's future, such as changes to protocols or fee structures. This community-driven approach has empowered users to have a say in the direction of DeFi projects, contributing to a more democratic and decentralized financial ecosystem. However, while the potential of DeFi is vast, it is important to acknowledge that there are risks involved. DeFi platforms are still relatively new and, as with any emerging technology, there are concerns around security vulnerabilities, regulatory uncertainty, and the potential for fraud or hacking. DeFi protocols are powered by smart contracts, which are susceptible to coding errors or exploits, as evidenced by several high-profile hacks and exploits in the DeFi space. Additionally, the lack of regulatory oversight in many jurisdictions raises questions about how DeFi platforms will be treated under existing financial laws and whether they will be subject to new regulations in the future. As the DeFi space continues to evolve, users must exercise caution and conduct thorough research before participating in any platform. The future of tokenized assets and investment portfolios. The world of investing has seen several shifts over the years, from traditional stocks and bonds to real estate, commodities, and more. However, one of the most revolutionary transformations in the investment landscape in recent years has been the rise of tokenized assets. The concept of tokenization refers to the process of converting ownership of real-world assets into digital tokens on a blockchain. These digital tokens represent a fraction of the ownership, and they can be traded, bought, or sold on various blockchain platforms, similar to cryptocurrencies like Bitcoin or Ethereum. Tokenized assets have the potential to disrupt traditional investment portfolios and redefine how investors approach wealth building. As blockchain technology evolves and becomes more integrated into mainstream financial systems, tokenized assets are set to become an integral part of investment portfolios, offering numerous benefits such as increased liquidity, fractional ownership, and broader access to diverse markets. At its core, tokenization involves creating a digital representation of an asset, whether it's a piece of real estate, an art piece, a share of a company, or even commodities like gold or oil. This digital token, stored on a blockchain, acts as proof of ownership. By leveraging the transparency, security, and decentralization of blockchain technology, tokenized assets can facilitate easier and faster transactions. Blockchain's immutable nature ensures that ownership records are permanent and cannot be altered, adding a layer of security that traditional asset management systems lack. These features present a host of opportunities for investors, making tokenized assets an appealing addition to modern investment portfolios. One of the most significant advantages of tokenized assets is increased liquidity. Traditionally, many types of assets, such as real estate or fine art, are illiquid, meaning they cannot easily be converted into cash without a lengthy sales process. For example, if an investor wants to sell a property, it could take months or even years to find a buyer, complete the paperwork, and finalize the deal. Tokenization allows for the fractionalization of these assets, meaning that instead of buying an entire property or artwork, an investor can purchase a fraction of the asset in the form of digital tokens. This makes it easier for investors to buy and sell fractions of high-value assets, dramatically improving liquidity. Through tokenized assets, real estate, art, and even private equity shares can be more readily traded on secondary markets, offering investors the opportunity to exit their investments more quickly and efficiently. Another compelling feature of tokenized assets is fractional ownership. In traditional investment markets, certain assets may be out of reach for average investors due to their high value. For example, purchasing an entire apartment building or a famous painting can require significant capital investment. Tokenization breaks down these high-value assets into smaller, tradable units, allowing a broader pool of investors to participate in the market. Fractional ownership democratizes access to high-value assets, enabling people with limited capital to diversify their investment portfolios by holding a small portion of multiple high-value assets. For instance, an investor could own a fraction of a luxury property in New York, a rare piece of art, and shares in a private startup, all without needing millions of dollars. This fractional ownership model opens up investment opportunities to individuals who previously would not have had the financial means to participate in these markets. Tokenization also enhances transparency and reduces the complexity of managing assets in investment portfolios. Blockchain's decentralized nature means that all transactions involving tokenized assets are recorded on an immutable ledger that is publicly accessible. This level of transparency ensures that investors can track the ownership history, transaction details, and provenance of the asset in real time. For example, in the case of tokenized art, investors can trace the artwork's history, confirming its authenticity and ownership status at any point in time. In traditional markets, this process of verification can be costly and time-consuming, but blockchain technology simplifies it, providing an added layer of trust. Furthermore, because blockchain transactions are automated through smart contracts, the process of transferring tokenized assets between parties is faster and more efficient than traditional methods, which often require paperwork, third-party intermediaries, and manual processes. Additionally, tokenized assets provide investors with greater access to global markets. Traditional financial systems often involve barriers such as geographical limitations, currency exchange issues, and complex regulations, making it difficult for investors to access certain markets. Blockchain, however, enables tokenized assets to be traded across borders seamlessly. A tokenized piece of real estate in London can be bought and sold by an investor in Singapore without the need for currency conversions, cross-border regulations, or lengthy approval processes. This opens up investment opportunities in markets that were previously inaccessible, further diversifying an investor's portfolio and providing access to global opportunities. The potential for tokenized assets to enhance the diversification of investment portfolios is also a crucial benefit. Traditional portfolios often rely on a mix of stocks, bonds, and other conventional assets, but tokenization allows investors to tap into entirely new asset classes. Real estate, art, intellectual property rights, precious metals, and even sports teams can all be tokenized and added to an investment portfolio. The ability to invest in a variety of asset classes is essential for portfolio diversification, as it reduces risk by spreading investments across different sectors and industries. Tokenized assets allow investors to easily adjust their portfolios to include a mix of traditional and non-traditional investments, increasing exposure to different markets and potentially enhancing returns. Tokenization also brings efficiency and cost reduction to asset management. In traditional markets, managing assets and transactions typically involves multiple intermediaries, such as brokers, custodians, and lawyers, each of whom charges fees for their services. These fees can eat into an investor's returns, especially when dealing with illiquid or high-value assets. Tokenized assets, however, are often traded directly between parties through smart contracts, eliminating the need for intermediaries. Smart contracts automatically enforce the terms of the transaction, ensuring that assets are transferred securely and efficiently. This reduction in intermediaries can lower transaction costs and make the entire process more cost-effective for investors. Despite the many benefits, the adoption of tokenized assets in investment portfolios is still in its early stages, and there are challenges that need to be addressed for this technology to reach its full potential. One of the primary concerns is regulatory uncertainty. Governments and financial regulators around the world are still grappling with how to classify and regulate tokenized assets. While blockchain technology has proven its value in providing transparency and security, the legal status of tokenized assets remains unclear in many jurisdictions. The lack of clear regulations could create uncertainty for investors, especially if there are concerns about the taxation, legal recognition, or protection of tokenized assets. Furthermore, the volatility of cryptocurrencies and digital tokens can pose risks to investors in tokenized assets. While the value of tokenized real estate or art might not fluctuate as dramatically as that of cryptocurrencies, the underlying blockchain infrastructure can still be subject to price volatility. Investors must consider the risks associated with the volatility of the underlying digital tokens, especially if they are trading on highly speculative or new platforms. For tokenized assets to gain broader acceptance, there will need to be more stability in the blockchain and token markets, as well as stronger safeguards against market manipulation. Another challenge lies in the technical aspects of tokenization. Tokenizing an asset requires a deep understanding of blockchain technology, smart contracts, and the mechanics of digital tokens. While blockchain platforms are improving in terms of user-friendliness, the process of tokenization may still be complex for individuals who are unfamiliar with the technology. Additionally, tokenizing certain assets, such as real estate or intellectual property, requires compliance with legal frameworks and a clear process for verifying ownership and transferring rights. Ensuring that tokenization platforms comply with these regulations and offer secure solutions for asset tokenization will be crucial for widespread adoption. Despite these challenges, the future of tokenized assets in investment portfolios remains promising. As blockchain technology matures and regulatory clarity improves, tokenized assets are likely to become more mainstream, with institutional investors and individuals alike incorporating them into their portfolios. The potential for increased liquidity, fractional ownership, diversification, and access to global markets is undeniable. In addition, the ability to automate and streamline asset management through smart contracts will continue to drive the efficiency and cost savings that tokenized assets offer. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Enhancing transparency in wealth management through blockchain wealth management has traditionally been a sector characterized by a lack of transparency. Investors, clients, and asset managers have long relied on intermediaries, such as financial institutions, brokers, and advisors, to manage portfolios, execute trades, and provide financial advice. While these intermediaries have provided valuable services, their involvement often introduces opacity, with clients having limited insight into the underlying processes and decision-making. The financial industry's reliance on outdated legacy systems has further compounded this issue, with inefficiencies, mismanagement, and lack of accountability leading to trust issues between clients and wealth managers. However, the rise of blockchain technology is revolutionizing the wealth management landscape, offering unprecedented levels of transparency, security, and efficiency. By leveraging the decentralized, immutable nature of blockchain, wealth managers and investors alike can experience a new era of transparency that not only enhances trust but also optimizes the entire wealth management process. Blockchain, the technology behind cryptocurrencies like Bitcoin and Ethereum, is a decentralized and distributed ledger system that records transactions across multiple computers in such a way that the records cannot be altered retroactively without the alteration being detectable. This feature of immutability ensures that once data is recorded on the blockchain, it is permanent and transparent to all participants. Transactions are verified by a consensus mechanism, and each transaction is linked to the previous one, creating a transparent chain of events. This transparency is one of the key attributes of blockchain that makes it a game changer for wealth management. In the traditional wealth management space, investors often have limited access to real-time data about their portfolios. Investment managers may provide periodic reports, but these reports are often delayed, and the information contained within them may not fully reflect the current status of the portfolio. Moreover, the decision-making process behind asset allocation, rebalancing, or other investment strategies can be opaque, leading to questions about how funds are being managed. Blockchain, however, offers real-time, transparent tracking of every asset and transaction on the blockchain. Each trade, investment, or movement of funds can be recorded on the blockchain, providing clients with up-to-the-minute updates on their portfolios. This increased transparency allows investors to track their assets' performance in real time and gain a deeper understanding of how their wealth is being managed. One of the most significant ways blockchain enhances transparency in wealth management is through the elimination of intermediaries. In traditional systems, intermediaries, such as custodians, clearinghouses, and brokers, are responsible for facilitating transactions and maintaining records. While these intermediaries are essential for ensuring the smooth functioning of financial markets, they also introduce complexity and additional costs. Blockchain removes the need for many of these intermediaries by enabling peer-to-peer transactions that are secured through smart contracts. These self-executing contracts are programmed to automatically execute when certain conditions are met, without the need for third-party intervention. This reduces the opportunity for human error, fraud, or manipulation, and it ensures that the terms of a transaction are carried out as agreed. Moreover, blockchain's decentralized nature means that all parties involved in a transaction have access to the same information. This reduces the risk of discrepancies between different parties' records and increases trust between wealth managers and their clients. In the past, clients may have had to trust wealth managers to manage their investments in a responsible manner without being able to independently verify their actions. With blockchain, however, clients can directly access a transparent and auditable record of their assets, transactions, and holdings. This open-source approach to data sharing fosters accountability and encourages wealth managers to act with greater integrity. Smart contracts are another key innovation enabled by blockchain that significantly enhances transparency in wealth management. A smart contract is a self-executing contract with the terms of the agreement directly written into code. These contracts are executed automatically when predefined conditions are met, without the need for intermediaries. In the context of wealth management, smart contracts can be used to automate the execution of investment strategies, such as asset rebalancing, dividend payments, or tax optimization. For instance, a smart contract could be programmed to automatically execute a trade when an asset reaches a certain price point, ensuring that the client's investment strategy is carried out exactly as intended, without the potential for human error or manipulation. This not only streamlines the investment process but also provides a transparent and verifiable record of each action taken. Tokenization is another blockchain-based innovation that is transforming wealth management and enhancing transparency. Tokenization refers to the process of converting real-world assets, such as real estate, stocks, or art, into digital tokens that represent ownership of a fraction of the asset. These tokens are recorded on a blockchain, making the ownership and transfer of these assets transparent and verifiable. Tokenized assets allow for greater liquidity, fractional ownership, and easier transferability compared to traditional investments. Wealth managers can use tokenized assets to create diversified portfolios that include a wide range of asset classes, while clients can monitor the performance and ownership of each tokenized asset on the blockchain. Tokenization reduces the complexity and opacity of managing physical assets, such as property or artwork, and provides a clear, real-time record of ownership and value. The increased transparency offered by blockchain also has implications for regulatory compliance and reporting. In traditional wealth management, clients rely on wealth managers to ensure that their investments comply with relevant laws and regulations. This often involves complex paperwork and manual reporting processes, which can be time-consuming and error-prone. Blockchain, however, can automate compliance by embedding regulatory requirements directly into smart contracts. For example, a smart contract could be programmed to ensure that investments comply with anti-money laundering (AML) and Know Your Customer (KYC) regulations by verifying the identity of clients before a transaction is executed. This reduces the administrative burden on wealth managers and ensures that clients' investments are always in line with regulatory requirements. Furthermore, blockchain's transparent nature provides regulators with real-time access to transaction data, making it easier to monitor compliance and detect fraudulent activities. Another area where blockchain enhances transparency is in the management of fees and costs. In traditional wealth management, clients often face a lack of clarity regarding the fees they're being charged for various services. These fees can be opaque, with clients having little visibility into how their wealth managers are compensated or how much of their returns are being taken in fees. Blockchain can address this issue by providing a transparent and immutable record of all fees and charges associated with an investment portfolio. Each fee, whether it's a management fee, performance fee, or transaction fee, can be recorded on the blockchain, allowing clients to see exactly how much they are being charged and how those fees are calculated. This transparency fosters trust between wealth managers and clients, as clients can verify that they are being charged fairly and in accordance with the agreed-upon terms. Additionally, blockchain technology enhances the transparency of the investment process by enabling real-time tracking of asset performance. In traditional wealth management, clients often receive performance reports that are delayed and may not reflect the current state of their investments. With blockchain, clients can monitor the performance of their portfolios in real time, accessing up-to-date information about the value of their assets, the performance of individual investments, and the overall health of their portfolio. This level of transparency empowers clients to make more informed decisions about their investments, as they can track the impact of market movements, changes in asset value, or the performance of specific strategies. The integration of blockchain into wealth management also opens the door for the use of decentralized finance (DeFi) solutions. DeFi refers to a set of financial services built on blockchain that operate without intermediaries, such as lending, borrowing, and trading. DeFi platforms allow individuals to access financial products directly from one another, using blockchain-based smart contracts to facilitate transactions. Wealth managers can incorporate DeFi protocols into their clients' portfolios, providing access to new investment opportunities that are transparent, decentralized, and secure. Clients can track their investments and transactions on the blockchain, gaining greater visibility into the performance of their DeFi assets. The integration of DeFi with traditional wealth management creates a hybrid model that blends the benefits of decentralized, transparent systems with the expertise of traditional financial advisors. Challenges and opportunities of integrating blockchain in finance. Blockchain technology has emerged as one of the most disruptive innovations of the 21st century, gaining significant traction across various industries, particularly in finance. Blockchain's promise of decentralization, transparency, security, and efficiency has made it a key player in transforming financial systems. From reducing fraud and operational inefficiencies to enabling new financial products like cryptocurrencies and decentralized finance (DeFi), the potential applications of blockchain in the financial sector are vast. However, despite its promise, integrating blockchain into the financial services industry comes with its own set of challenges. The implementation of blockchain faces regulatory hurdles, scalability concerns, technological complexities, and the need for industry-wide collaboration. This video explores the challenges and opportunities associated with integrating blockchain in finance, emphasizing the transformative impact it could have on the sector. The promise of blockchain in finance. Blockchain is a decentralized digital ledger that records transactions across a network of computers in such a way that they are immutable and transparent. The technology was first introduced with Bitcoin in 2008, but its potential goes far beyond cryptocurrencies. In finance, blockchain offers the possibility of reducing the reliance on intermediaries, streamlining processes, and enhancing transparency and security. For example, blockchain can enable peer-to-peer transactions without the need for traditional banks or financial institutions as intermediaries. This could dramatically reduce transaction fees, increase the speed of transactions, and eliminate many of the inefficiencies that plague traditional financial systems. One of the most promising applications of blockchain in finance is its ability to enhance transparency. Blockchain records every transaction in a way that is publicly visible to all participants in the network. This can greatly reduce fraud and the risk of financial crimes such as money laundering and insider trading. The decentralized nature of blockchain ensures that no single party can alter the transaction history, providing a high level of trust in the system. Moreover, blockchain can be used to create smart contracts, self-executing contracts with the terms of the agreement written directly into code, thereby automating complex financial transactions, reducing human error, and ensuring greater compliance with regulations. 1. Regulatory uncertainty and legal frameworks. One of the most significant barriers to the widespread adoption of blockchain in finance is the lack of regulatory clarity. Governments and regulators around the world are still in the process of understanding blockchain and developing frameworks to regulate its use. Financial institutions, such as banks, are typically highly regulated, and integrating blockchain into these systems raises a host of legal and regulatory questions. For instance, how should blockchain-based transactions be treated for tax purposes? What standards should apply to smart contracts? How should data privacy laws be enforced in a decentralized system? The uncertainty surrounding these regulations makes it difficult for financial institutions to implement blockchain-based solutions with confidence. Without clear guidelines, firms may be reluctant to invest in blockchain technologies, fearing that they may inadvertently run afoul of regulators. Additionally, different jurisdictions may have conflicting views on how to regulate blockchain, making it challenging for multinational organizations to implement consistent blockchain solutions across their operations. 2. Scalability and transaction speed. Another major challenge in integrating blockchain into finance is scalability. Blockchain networks, particularly those that use proof-of-work consensus mechanisms, like Bitcoin, are often criticized for their slow transaction speeds and high energy consumption. The process of validating transactions and reaching consensus on the network can take a significant amount of time, which is impractical for real-time financial transactions that require quick execution. In traditional financial systems, transactions can be processed almost instantly, thanks to the use of centralized clearinghouses and intermediaries. In contrast, blockchain networks may require several minutes or even longer to confirm transactions, which makes them less suitable for high-frequency trading or other time-sensitive financial activities. 3. Integration with legacy systems. The finance industry is built on a complex web of legacy systems that have been in place for decades. These systems are often outdated, proprietary, and incompatible with modern blockchain technologies. Integrating blockchain into existing financial systems is a significant challenge, as it requires a complete overhaul of these legacy systems or the development of hybrid solutions that can bridge the gap between traditional systems and blockchain-based solutions. The integration of blockchain into legacy systems is not only a technical challenge but also a logistical one. Financial institutions would need to invest heavily in new infrastructure and retrain their staff to manage and operate blockchain-based systems. This can be a time-consuming and expensive process, and many institutions may be hesitant to undertake such a large-scale transformation without a clear return on investment. 4. Data privacy and security concerns. While blockchain is often hailed for its security features, the issue of data privacy remains a significant concern, particularly in the finance sector. Blockchain's transparency means that every transaction is recorded on the public ledger and is visible to all participants in the network. While this transparency can enhance trust and reduce fraud, it also raises questions about how sensitive financial data, such as personal identification and transaction details, can be protected in the finance industry. Privacy is critical. Financial institutions must comply with strict data privacy laws, such as the General Data Protection Regulation, GDPR, in Europe, which requires that customer data be protected and that individuals have the right to request that their data be erased. The immutable nature of blockchain, however, makes it difficult to delete data once it has been recorded on the ledger. This creates a potential conflict between blockchain's transparency and the need to protect individuals' privacy. To address these concerns, blockchain developers are working on solutions that allow for greater privacy while maintaining the benefits of transparency. For example, zero-knowledge proofs and other cryptographic techniques can enable private transactions on a public blockchain without revealing sensitive information. However, these solutions are still in the experimental phase and need to be tested for scalability and effectiveness. Opportunities in integrating blockchain into finance. Despite the challenges, the integration of blockchain into finance offers significant opportunities. The potential benefits of blockchain in the financial sector are vast, ranging from reducing costs and improving efficiency to creating new financial products and services. Here are some of the key opportunities. 1. Cost reduction and efficiency gains. Blockchain has the potential to significantly reduce costs and improve efficiency in the financial sector. By eliminating intermediaries, such as banks, brokers, and clearinghouses, blockchain can streamline processes and reduce transaction fees. For example, cross-border payments, which typically involve multiple intermediaries and high fees, can be processed more quickly and cheaply using blockchain technology. Blockchain can also automate many of the manual processes that currently dominate the financial industry. Smart contracts, for instance, can automate the execution of financial agreements, such as loan disbursements, insurance claims, and trade settlements. This reduces the need for human intervention, speeds up the process, and lowers the risk of errors. 2. Enhanced transparency and security. One of the most significant benefits of blockchain in finance is its ability to enhance transparency and security. Blockchain provides a transparent, immutable ledger of transactions that is visible to all participants in the network. This makes it much more difficult to manipulate financial records or commit fraud. Financial institutions can use blockchain to ensure that their operations are transparent, auditable, and compliant with regulations. In addition, blockchain's decentralized nature makes it less vulnerable to hacking and cyber attacks. In traditional financial systems, a centralized database or clearinghouse represents a single point of failure. A cyber attack on this centralized infrastructure could have catastrophic consequences. With blockchain, however, the decentralized network makes it much more difficult for attackers to alter the data or disrupt operations.